Hello and welcome to the special Montel webinar, Is the Energy Crisis Over? It's fair to say that 2022 was a year like no other. Record high energy prices, demand destruction, extreme volatility, energy poverty and political intervention. And I think it's also okay to say that Europe was saved by mild weather in the November to January period. I think the addition the cutting of dependence on Russian gas was extremely impressive, even if it does mean locking in fossil fuels by the way of new LNG terminals. But are we really out of the woods? What's the outlook for 2023 and next winter in particular? Certain questions remain. Will European industry be able to return to full production after a few very tough years? What will happen to Chinese LNG demand? And have market interventions scared away investors into new, much-needed renewables capacity? Also, has Joe Biden thrown a spanner in the works with the US Inflation Reduction Act, which is potentially triggering a trade war for renewable subsidies between the EU and the US? Joining me, Richard Sverrisson, are two expert guests. Trevor Sikorsky of Energy Aspects, welcome. And Tobias Federico of Energy Brainpool. Also, a warm welcome to you.
Thank you.
I'd like to start, Trevor. You have some slides for us, so you'd like to talk to us about what's happening or what's the outlook in terms of the gas market. So please, the floor is all yours.
Thank you, Richard, and very good to see you again. So we'll start on the gas market, and we've got some slides here. And really, we've started with crisis, what crisis? And I think if you look at what's, of course, happened to gas prices, recently, certainly a massive repricing downwards from those very, very high levels that were seen last summer. And that's taken a lot of kind of pressure out of the market. And it kind of feels like there's a degree of normality. And when you look at both our forecasts and the curve, but you are looking at a consistent pattern where gas prices will stay above 50 euros per megawatt hour. So historically, it's still at very, very high levels, levels we've never really seen before. It's just that these levels probably feel a lot more manageable than, let's say, the 200 euros levels that we saw last summer. So certainly a lot of easing, and a lot of that easing, of course, is a result of what's happened with European inventories. So those gas inventories massively, improved at the end of the year. We saw, gas inventories getting very, very high, and indeed starting January very, very high after a very mild November. Now, December and January, interestingly, weren't that mild, right? There was mild bits and then there was cold bits, and they kind of came out more or less normal, but that very mild November, and then what we've seen in terms of demand side response to high prices being very, very important in what gas prices have done and that ability to reprice downwards, and indeed reflect in people's expectations on that. Now, of course, what happened, as you said in your opening remarks, is the big change in Russian gas supply. And you can see how much gas came out of the European market very, very quickly and very, very abruptly. And, you're looking at something like 77 BCM disappearing, and that's, a huge amount, like 20% of European supply overnight disappearing from the market. And so, yes, of course, that led to a lot of volatility and led to a lot of pricing. Now, the other important thing to really kind of consider is that's also gas that has disappeared from the global market, because really the Russians just don't have enough infrastructure to get that gas anywhere else. So it was this massive European supply shock, but it was also a supply shock to the rest of the world. And it was that supply shock to the rest of the world really coming through what happened to LNG. And you can see we really, really relied on LNG, and LNG really, came into its own in terms of, that flexibility and the ability for Europeans, to use a lot of regas capacity that hadn't been used very heavily, and was a real kind of godsend almost to the European market. Of course, filling up those facilities, and you can see how much it increased in terms of supply and offset a big chunk of that, those reductions in Russian supply. But the ability to do that, of course, relied on demand side reductions and destruction. And that demand side reduction happened in Europe, but it also happened in the places where we were taking a lot of that LNG from, and that included China, that included South Asia as being, the big regions that lost a lot of LNG last year, and of course allowed Europe to take that in. Now, interestingly, in this picture, you can see in terms of our expectations for 2023 is we don't actually have any additional LNG coming into the market, into the European market. We kind of feel that we'll get about the same amount as last year, but not that much more. And the reason for that is a combination that you don't have very much incremental supply coming in 2023. You've got a little bit, but you can see that the market really has to wait a long time, really until 2026, 27, when you get a lot of incremental LNG into the market. The other thing, of course, and the reason is you do have some incremental supply coming into the market in 2023. It's not that much, but in comparison, but it is 10 to 12 million tons, and that's kind of, we do think that is going to be offset by a return of Asian gas. And this is one of the key interactions, because certainly to keep Asian demand down, you need reasonably high prices. As prices come down, then some of that Asian demand comes back, and certainly we do expect China, which had a number of things happen to it in 2022, including big COVID shutdowns, particularly around Shanghai, but even in wider places, and a very, very slow year for industrial production in China, which allowed the Chinese to kind of lose some of its demand. We do see that coming back. We see a little bit already. We see with prices down around the 50 euro area, and TTF at the TTF, and of course the JKM pricing below $20 per MMBTU. Without that type of pricing, we are even starting to see some of the Southeast Asian buying come back into the market. So this is this big balancing act between demand and supply, and that's going to be one of the key things, and one of the key things that stops European prices from going much lower is this need to continuously attract LNG. Now, those demand reductions will need to come from other places. It will need to come from Europe as well. And you can see from these charts how severe that, how big that reduction in industrial demand was last year, and how that has to stay in 2023 and 2024 for the gas markets to balance. We've also seen it in Rescom. So you can see in Rescom, certainly if you look at the HDD adjusted numbers, that would be the blue line on the chart on the right. The red line, the actuals coming in, 14-15% lower than those HDD adjusted numbers. So a lot of demand side response in the European market, and a lot of demand side response in Asia. And these are one of the things that has to continue for the European market to continue to balance comfortably. You have to continue to see this low demand. Now, when we look at the industrial demand reductions, you can see that it came from a number of things. Some of it was lost output, and certainly that was important, and this does raise questions about, the kind of, how deep is a recession going to be? And certainly, prices are probably getting to a place where it's saying that your European recession is going to be less severe than what was feared earlier. And certainly if you look at PMIs at the beginning of February, a good indicator of what's happening with European industry, we're better than they have been, over the past 6 months. And certainly they were still saying contraction, they were still in contractionary territory, but they were a lot better than what we'd seen previously. So I think all of this is is key and is going to be important for making the market balance. Now, the other thing that is going to be important, of course, is a lot of the remainder of the reduction in gas demand came from fuel switching in particular, and that's gas to liquids or gas to coal. And those are really, really important pricing points, because as soon as you start getting below that, then you start bringing back that fuel switch quite quickly. And so that starts adding back into gas demand. That will start eroding start eroding the storage balances, will make it harder to fill, even though we're not going to have that much probably to fill, as we showed on the first slide, but it's going to have, a huge amount of kind of implications. And it is this gas switching, these gas switching numbers, particularly things like gas to LPG, which was particularly important in sectors like refining, all of these being very, very, very important pricing points in the European market, and most of those, as you can see, coming in around that 50 euro numbers at the bottom. And so as you start getting below that, then we'd see the market having an enormous amount of resistance. So and so looking a little bit forward, what is, when does this change? Well, these kinds of concerns are going to be with us for a couple of years. Probably not going to change that much. Yes, you could have a reduction, let's say, in coal prices, or you could have a reduction in, LPG and stuff like that, allowing prices to get a bit lower. But these are things which are going to keep gas prices reasonably high this year, and high next year, and high the year after. And so you are looking, at 2 to 3 years of historically high gas prices still in front of us, even if, the big concerns about gas rationing and things like that, certainly at the moment, don't look like they're going to trouble us all that much in 2023. And back to you, Richard.
Perfect, Trevor. So, I'm just going to ask you a couple of questions now, maybe following up from your slides there, but I'd like to focus on a number of issues that you highlighted on your presentation later on in the discussion. But so, if I understand you correctly, it was pretty clear. Prices will be at a Euro 50 floor, probably for the next couple of years. But where do you expect price to average over 2023?
Well, we've got kind of summer coming in around where we are now, so not a huge amount probably going to move the markets around, just because we have, a very, very good storage carryout that we're expecting for March. So that's bearing, some really, really cold weather sometime between now, and the end of March. But we are expecting probably a carryout of about 60 BCM, which I think will mean, yes, that, you won't be able to get that much gas demand back into the market. So that will continue to continue to play out. But we would expect, in Q4, certainly with weather adjusted, with weather driven demand coming back into the picture, the market will have to price out, and so we are looking, at an average of probably, 60 to 70, getting a lot higher next winter than they are this year. And certainly, as you said in the beginning, November really helped out, being super, super mild, probably nobody really turning their heating on, that's almost unheard of in a November. And that really, I think, meant that we could have a couple of cold spells, in December and in January, and really the market really not having to, price up in any material way on the back of that weather.
So slightly above 50 until for the next few quarters, then we could go up towards 60, 70 in the last 3 months of the year, if that's...
Yes, absolutely.
Yeah. Perfect, Trevor. Thank you. I'd like now to turn to Tobias Federico in Berlin, who will talk us through the perspective from Germany. So, Tobias, over to you.
Thank you, Richard. I just want to share my small presentation I'm having. Good. So my focus is a little bit on Germany. I would like to focus a little bit more on the power market rather than the gas market. But agreeing with Trevor, I said, well, what crisis? Not really, but do we have a Corona-like behavior? If you remember the 2 Corona years, in wintertime, we always had an issue and summertime was all good. And then we hope for the next better winter. I think in the energy crisis, it's a little bit the same. So we have a quite good winter, summertime is easy, and the next winter, let's see what's going to happen there. But looking back, as Trevor said, inventories are still high. We might come out in Germany with 50 to 60% storage level after the winter. So it's easy to fill them up again. That's fine, but it wasn't clear all the time. When we see the right graph, we do see the year-ahead gas prices. They did increase and spike for the year-ahead base contract in August 2022 at around about 300 euro. And of course, according to that, with a very high correlation, the power market, this is the year-ahead base contract for Germany. And on the 27th of August, we peaked with 1,000 euro. After that, prices dropped. There was still the fear about a cold winter, but inventories have been quite good on the gas side. That's why power prices dropped. Then we had a very mild winter. So price levels are a little bit before the war level, but not before the crisis level in total. Which on one side sounds to be very good news for consumers, for utilities, and for trading companies. Both price directions are an issue, especially when you look into collaterals and margin calls. Because when you have a long position, prices are rising, you have to place margin. But also if prices are falling, the margin questions are still there. And today's situation, at least between German municipalities and utilities, that margin calls at lower levels right now are still an issue, because most of the procurement did take place last year, around about 200 to 300 euro per megawatt hour for power. And now at the current price level, it's around about 180. You still have to place margins. So that's a liquidity problem. And for us, at least from our point of view, that's one of the big threats we are facing, at least in the next periods. It might be over at the end of this year, but right now for the German utilities, that's an issue. Looking onto the long-term side, we have to look into the gas market. I totally agree with Trevor. This slide we've made, it was not a fundamental analysis, much more a gut feeling. How could the gas market behave? We had the red shaded area with extreme prices. We called that panic period. So we have been there. We are a little bit moving out of that. And the yellow period for us is the period of the market a little bit consolidated, but not with an oversupply. So we are still competing with the Asian gas market. That's why in certain periods we might see very high gas prices, and then we are going to see high power prices. But we do expect a certain oversupply period then on the longer term until the end of this or at the end of this decade, with gas price levels between 20 and 60 euro per megawatt hour. We will not come back to the pre-war level with 20 euro Russian pipeline gas prices. I think that's over, that's quite sure. Even if Russia would, the new Russia maybe, would continue to deliver pipeline gas to Europe someday, the majority will be LNG gas, which will come to Europe, and that's then the price setting gas prices. So this is one threat, and of course it had consequences, especially for the end users. And we have seen huge price increases for German end users, as well on the gas side as on the power side. And most of the gas reduction was avoiding these type of high costs until the German government made the law for a price cap, which officially is not in place. It will start on the 1st of March, but will then start back counting from the 1st of January for end users. So prices are kept there for household at 12 cents per kilowatt hour, and for industrial users at 7 cents per kilowatt hours. 7 cents means net, so without any additional fees. So that's more or less the wholesale market price. If you translate that to the wholesale market price itself, then it's 70 euro. For a household in the power sector, prices are limited to 40 cents per megawatt hour, per kilowatt hour, sorry. And for industrial consumers, it's 12 cents per kilowatt hour, which is 120 euro per kilowatt. On the top, we have an example of a very small utility in Germany, which is quite representative for today's price levels. So end users are paying 43 euro for 43 cents for electricity and 18 cents for gas. And the gap between the price cap and the official tariff from that utility will be paid by the government. And the government has placed an amount about, I think, 200 billion euro just for the power and gas price cap until April 2024. Which somehow for the end users is good, but due to the fact, as we've seen in the slide before, that the wholesale market prices really dropped quite low, we have a competing situation which might start soon. That is, the competition between utilities will resume. It did stop in the summer last year until recently. And the main reason is that your wholesale prices have been quite high, but with this very low wholesale prices, you have right now the chance with a, let's say, quite risk-friendly procurement averse, so you buy everything right now and give it to the end customer, to be cheaper than the price cap. And you are definitely, and that's the right table, the red marked cell, you are currently cheaper than the procurement strategy of conventional, let's say, utilities with a very risk-averse approach that you buy electricity in trenches for a 1 or 2 year period. What means that most of the utilities bought the electricity for the end users last year, but the end users might disappear during the year if the wholesale market prices are falling or still falling. So that's a threat, competition. Sounds to be a bit weird that competition is the threat, but this type of competition, we've seen it in 2008 and 2009. There came new market player on the market with very low prices because they didn't have a old customer portfolio. They have just rebuilt the customer portfolio. They make a procurement on the spot market, which is much cheaper than the forward market was beforehand. And therefore, they're getting all the customers. So that's a threat for German utilities, at least within the next 2 years. As I said before, the price cap for the end users will cost around about 200 billion euro for the German government. At least that's the expectation. Might be a little bit lower, but somehow it has to be refinanced. And one way to refinance that was to place a revenue cap on, it's officially called inframarginal power producers. And that's the next slide. We had an approach from the EU level where they said, okay, there needs to be a revenue price cap for all the type of power plants on the day-ahead market, which are not based on natural gas, which is coal, lignite, hard coal lignite, nuclear, and renewables. They call them inframarginal producers. And at least the approach from the EU side was that they have a fixed maximum allowed cap. The German government, and this is part of the end user price cap law, did implement parts of it, but in their own way. So we have a revenue cap right now in Germany, and it will start in March, but we have a back calculation from November last year, which will hit mostly renewable energies, nuclear energies, and lignite power plants. Hard coal power plants are not part of that, and of course, not natural gas power plants. And the revenue cap is a little bit depending on what type of technology you're having. And sometimes it's fixed set prices. And for nuclear, for example, it was until December last year, 4 cents per kilowatt hour, so 40 euro, plus an additional margin of 30 euro per megawatt hour. And the surplus of selling that, that's the revenue cap, which you have to give to the government. And for lignite power plant, for example, it's depending on their short-run marginal cost plus additional cost. For renewables, it's depending on their old bidding behavior, or for offshore wind energy, for example, it's 10 cents per kilowatt hour, which is 100 euros. So anything on top of that it's a revenue, which is a surplus, and this has to be given to the government. The law itself is a little bit complicated. The mechanism is quite complicated, and it's a lot of paperwork to do, especially when you did long-term hedging. You can add that to your profit or deduct that from your profit. A lot of paperwork, but the focus is that the government will get money to pay the end user price cap. And of course, for an investor, that's a threat. When you plant your power plant, when you projected your power plant in renewable sector, and now this law came out, it's really hard to find a buyer for PPAs, at least at a very high price level. Of course, you can always find a buyer, but that was not your market expectation. And this type of interference wasn't there beforehand in the German market, so the insecurity is really high, and investors are not really frightened because, of course, the price levels have been very high, but it gives a certain insecurity into the market. And the next thing is, and that's threat number 4, that, and for me personally, I think the threat is much bigger than the threats we already saw, and also the huge challenge we had to switch from Russian pipeline gas to LNG gas. That's EU market regulation. And the EU wants to change the market design in total. Currently, there's a consultation going on. And when you look into the text, they say, well, the market was great, super until the energy crisis. And we have a number of shortcomings in the current market, especially that the regulatory framework regarding long-term instruments has proven insufficient. And then you see that protect large industrial consumers, household from excessive volatility and higher energy bills. And of course, we have two sides of a coin. That's the consumer coin. That's not the investor part. And the ideas currently are around the Spanish market design, which on one side has the capacity market for natural gas power plants, which is okay when we are speaking about, or if we are speaking about a missing money problem. It's not really okay when you say, okay, they are not allowed to bid anymore on the day-ahead market. Because then the day-ahead market is a little bit more isolated. You have to split up the demand. How is this designed on the day-ahead market, and especially on the renewable side? They are talking about contracts for differences. So you don't have a floor. You are limited. If you have a surplus of your income, you have to share that. And the reason for that was that high gas prices did increase the revenues well over expectations for many generators with low marginal costs, such as renewables. Which, okay, yeah, that's the part of the market design. But what was really the reason? Of course, high gas prices. But the gas prices have been excessively high because the government, especially the German government, gave to the gas transmission operator the right to buy gas at any cost to fill up our storage level to avoid a real gas shortage, which as an instrument itself was good. And I think we succeeded, as we can see it right now. But one of the collateral damage is, of course, high prices. And the next collateral damage, which might be much bigger, is that from the regulatory side, having high prices is bad for the end users. So that's why we have to change the whole market design to prevent high income for renewables. And that's definitely contradictory to our green targets. And that's something I really don't understand intellectually what's going on there. I understand it politically, but from the investor side, it really doesn't make sense. But okay, it's not in our hands, or at least just a little bit. That's thread number 4. And I have one more thread, which seems to be kind of obvious. Winter is coming. Thank you. That's from my side.
Excellent, Tobias. I'd like to discuss the sort of market design proposals a little bit later in the webinar. But in the meantime, allow me just to say that we also have a weekly podcast at Montel, and this week's episode is all about that consultation and the proposals on the table. So if anyone out there is interested in that, then please listen to that. That's out on Friday morning. But if I can ask you, Tobias, just a follow-up to your slide. So if I understand you correctly, a lot of the utilities and energy companies in Germany are facing threats from the competition, where companies can underprice them in the market, but also based on margin calls from last year. So do you expect the sector to see bankruptcies over the course of 2023 and 2024 as a result?
Well, bankruptcy is really a big word for that. At least they're financially really under pressure. We, from the German State Bank, the KfW Bank, we have additional financing for margin calls. This one has been extended, first in volume, second in the period. So utilities still can apply for that. That's one thing. The other thing, of course, is competition. And this strongly depends on how low power prices will fall, especially in the forward or in the spot market, how risk-friendly the new competitors are. And there are certain types of non-conventional utilities, I call them, which are just waiting to enter the market or re-enter the market again. And then, of course, it depends on the customers, whether they are willing to switch, especially on the household sector, to that type of provider, because these type of providers we've seen 2 years ago, in cases prices are increasing, they just stop delivery and are not delivering the energy, the commodity to the end user, which then again was a problem in that period for the utilities, because they were the fallback options in the case that your supplier is stopping the delivery. So it depends on those three factors. If they all three are going to happen, so at least the last two one, very low power prices and very high competition, then I assume that small municipalities, when they have, in case they have another additional problem, might face bankruptcy, but not only do that.
I mean, there's maybe one big utility that was too big to fail in Germany, but maybe we'll see if that applies to others in the sector. But Trevor, if I can turn to you and ask about, Tobias had the last slide was, the threat of winter. Have we been complacent? I mean, okay, you mentioned that in December and January there were, times when it got very cold, but when it got mild as well. But we're still only in early February. Could we be hit by another beast from the east or beast from the north or whatever in the weeks to come? And what kind of an impact could that have?
Yeah, I mean, there's always the possibility of getting cold weather, in a winter period. I mean, I think the key thing to take out from, the winter episodes that we have had, and there was 2 weeks of very, very, very cold weather in December and probably a week of very cold in January. And indeed, February starting with a cold, a bit of a cold spell as well. And the market's kind of been very, very, relaxed through that. And one of the reasons it has been is the impact of high prices on consumer behavior, right? And it's that fuel switching that we have seen in industry. It's the reduction, the reduction in output, which is, I think probably looks less severe now than it did, 3 months ago. But it's also that big reduction in rescom demand against, against the forecast. So, there is big sections of the population for which, even having, priced capped, let's say, utility prices for gas is still very, very difficult, on a budgetary need to meet, and does result in, I would say, does result in, in people undertaking a lot of gas saving, and power saving, so you are, lots of people, heating their homes less, doing with, colder temperatures, that kind of ambient temperatures in their homes. So that's been really, really important, I think, in helping, the market probably not really jump on, what we've seen is, a couple of cold spells, as they've come back into the market. I think you'd have to be very, very cold and very, very sustained, for this winter to really kind of begin to, move the, I'd say, the market, the market dynamics, for the coming summer. You'd probably need to cut out 10 BCM or so of the storage carryout for that to happen. So I think there's a little bit of headroom before the market starts moving up, but winter's always a risk. But I mean, it has been remarkable how we've got through the cold spells that we have with the market, and being able to be quite relaxed on those on that demand side behavior.
Exactly, and how we've sort of ridden through that the so-called the energy crisis here on that side in terms of security of supply, not so much maybe affordability, but Trevor, in terms of demand destructions, particularly amongst industry, do you see that, or which sort of sectors are potentially at risk of not actually coming back to the production levels that we saw pre-crisis?
A good question. I mean, when you look at, the activity indicators of who've fallen the most, I mean, building materials is, has been very, very weak. And of course, that feeds into the metals as well. So you're looking at, the steel production in Europe, you're looking at, cement production, all of those things being quite weak. Now, I think, you need you would need a lot of activity to come back for them to probably come back. But I think there is, there are big risks here, and the risks feel, a little bit smaller than they did maybe, 4 or 5 months ago when you were looking at 100 plus euros per megawatt hour for gas demand. But they're still very, very high, and globally, these prices are very, very high. And you can see anything which is fungible as being, anything that could be imported could be at risk from just a sustained period of comparatively high energy prices, and certainly if you compare them with the energy prices seen in the US or in the Middle East, areas like that, you would say, well, actually those areas have an enormous amount of energy price advantage over production in the EU, and so things like chemicals, in particular, are probably more easily imported than some of the heavier goods amongst that, like cement and stuff like that. But of course, you probably have some near-term neighbors that maybe could do that cheaper, and that just raises up, I think, one issue which is quite interesting, which is, in terms of European industrial strategy, but the United States Inflation Reduction Act, which of course has enormous amounts of subsidies inherent in it for investments in new technologies. And if you looked at, Fit for 55, one of the key things European policymakers were trying to get out of Fit for 55 was to build an industrial base producing all of the things that you need for industrial for the energy transition. And now all of a sudden you've got the US, which is offering a huge amount of energy price advantage, probably labor price advantage, and now significant subsidy for undertaking those investments. Attracting that investment is going to be very, very difficult. And we've already seen the EU, last week come out with a very rushed, I would say, and very patchy industrial strategy that was trying to address some of those threats.
So, Tobias, I think, the German government has obviously spent vast amount of money supporting and shielding its industry. But, following on from what Trevor's saying here, could it have sort of weathered a short-term storm, but in fact faces an existential threat from places like North America or Asia, where energy is cheaper, where there are these subsidies are available? Do you think that is an issue here for German industry and the German industrial kind of Standort?
Well, not in the short term, I think. Of course, it's always been talked about, but you don't switch your industry within 1 or 2 years that you go from here to, I don't know, China, Canada, US. So in the long term, in the long run, I think, yeah, it's definitely an issue. But I think the main reason why we do have a threat here or a reduction is definitely that high power prices or high energy prices did increase the production costs of most of the goods, which then drove inflation. And the domestic demand might drop. And that's a fear we are going to have within the next period. The question is, how is the government reacting to that? But with dropping domestic demand due to the fear of inflation and due to the fear of high energy bills within the next few months, the production stop of the industrials might be a bit more there, and then a shifting of the production somewhere else. On the other hand, we have a counter movement globally, which is not connected to energy prices itself. It's much more the strategic move to avoid dependencies on logistical interferences in the transport of your goods, what we've seen out of the Corona crisis. So it's not really clear. I think within the next 2 years, we might be fine, but in the long run, it might be an issue.
Do you see demand on the industrial side returning to pre-crisis level this year, or when do you see that happening?
Well, this year, not really. I think we have two drivers. One is really the domestic demand. And the total production costs. Currently, Germany has also quite a lot of strikes from laborers and unions because salaries have, of course, somehow to increase. And with increased salary, then we will have increased prices, also production costs on that side. But what we do see is that we have also the effect of the gas and power price cap, that it's only limited to 70 or 80% of your pre-year consumption. And that's an incentive also to reduce your energy consumption. Whether this is connected to reducing your production amount in total or increasing energy efficiency, that's not clear somehow. But we have these two drivers, which is quite likely that this year industrial production level will not go back to a higher level, but maybe next year in 2024, if prices are still falling and the price cap will run out in April 2024.
Thanks, Tobias. Trevor, you had a slide of Russian, you showed a graph of Russian flows into the EU, pipeline flows. Do you expect to see a complete cut in those ever in the sort of month in 2023? Could they just completely disappear, the pipeline flows?
It's a good question. I mean, we don't have that as our base case, and I think on that slide it was pretty flat between 23 and 25, and that is the assumption. So the assumptions really we would have is there's no way back for Russian gas through the northern routes, for a variety of reasons. Certainly not in the period out to 2025, but that. You will still see the Russians flowing through Turk Stream and still flowing through at around current levels through the Ukraine. And a lot of that, some of that is dependent on what happens with the TTF index against the TTF day ahead, because people can numb down a little bit on that. But apart from those kind of slight changes, it kind of feels like there is very little for the Russians to gain from taking the flows, any further down. It feels like, their leverage, what they saw was their big leverage, which was gas supply, has all been used up, and the Europeans have been very successful in sort of, replacing that with that combination of LNG and demand reduction. So, it's like that leverage is gone. What are you going to get if you take out that little bit? Well, you lose, the bit of revenue that you are getting, without probably having a major impact now on price levels, because the amount of gas that you can play with is very, very limited. And of course, what is going into the European market is often going into those countries which have been a little bit more pro-Russian, right? So, it's the Hungaries of this world and the Serbias and things like that. And that gas coming in, and you kind of say, well, are they going to remove that gas for that reason? And I think it becomes, more difficult to say, there's a good compelling reason for why it would go to zero, right? I mean, most of that, that political leverage has been used up and there's very little left. So all you're really doing is giving up revenue now, and and it kind of feels like if you really wanted to maximize that revenue, you would have already stopped the flows through the Ukraine, and that hasn't happened yet, right? That's not to say you might not, so you might get a missile or something hitting one of the pipelines or something, that's a kind of a different story, but that kind of thing can happen, and certainly it does feel like Europe's got to that point where it's hard to see it ever coming back, right? That need for Russian gas.
Tobias, can you ever see, or could you envisage a scenario where the flows were increased on the pipeline?
I think what the last 2 years or last 4 years crisis have seen or shown is that everything is possible. I would not deny it. I think there's a certain probability that gas flows might increase. The question is whether Nord Stream 1 and 2 will, or at least the 3 or 4 pipes, will be reused again. I think it's a quite huge investment to repair them. And it will definitely not come out of the current Russian regime. The question is what happens after Putin. If if we have a democratic approach, then it's nice. But if the Falcons will take over in Russia, it might take another year, another decade. Sorry, that we will come back to a normal relationship with Russia. I think we will never come back to the high import quotas we had, especially in Germany. And I hope the government has learned their lessons regarding diversification, not to depend too much on one big supplier. And in that case, it was Russia. Right now, we have LNG. LNG has the right potential to be diversified quite a lot. But there is a certain likelihood, but it's not very high.
One of the things I found quite surprising, Trevor, over the past few weeks is the data concerning Russian LNG imports into Europe. I know there's talk on the oil side, on other commodities of sanctions against Russia, but it seems to be there's a lot of LNG floating in or coming into Europe from Russia. Is that something we can expect to see for the remainder of 2023 and into 24 as well?
Well, I mean, LNG is one of those things where it kind of goes to your nearest ports, particularly when, for the Russians, when it's very hard to get your Mel gas into the Asian markets because during the winter, because that northern transit route, is closed. So, you need to, get it in somewhere reasonably close, even if you're going to, try and reload that and get it further afield, but it becomes a very, very long way to get it into that Asian market. And maybe you could see more of it going into the South Asian market, which is less far away, but it is still a long way. So, I mean, I think it's one of those things where, the market works reasonably efficiently in terms of its, in terms of kind of optimizing, shipping distances. And we're seeing, I don't think we're seeing anything, much more than that happening, at the moment.
I have a question here, just like from the floor, if you like, from the cyber floor. This is a question to both of you. Do you see gas and electricity reduction targets in the EU prolonged beyond the current phase, the current target of end of March 2023? And what impact could that have on prices and demand this year?
Yeah, I mean, I'll go for the gas side and Tobias can go on the power side. But on the gas side, I mean, it kind of feels like they have, I think at the moment, what you are seeing, is the prices being very, very satisfactory or very good at ensuring those reduction targets were effectively met. So yes, prices have to be expensive. If prices are expensive, either in industry or in rescom, you either see people switching away or doing without, and that's effectively how these targets have been kind of met. I would. I think in terms of the concerns, politically, it's a question about whether or not you can get the EU to agree. It was even difficult, when it looked like it was a real crisis to get the EU, like a crisis that would result in rationing. It was even quite difficult to get everyone to agree to those targets the first time. So politically, it might not be done. But if politically it's not done, you would still say economically, prices would still stay at levels that would make sure we still have energy savings, because we still don't have enough. We really still don't have enough energy, in the market to go back to previous levels of energy use.
Well, I would say it applies almost equivalent to the power market. First of all, in the case prices are high, there's a certain incentive to reduce the consumption. We've seen an issue in Germany where it was quite interesting to see that from the governmental side, you can say and set limits and implement the consumption reduction in a few sectors, but not in all sectors, especially not in the household. And household energy consumption behavior is quite interesting because it's driven by prices. We've seen huge potentials, especially on the heating side, how to reduce the energy consumption. I think the awareness has increased for most of the household that energy has a certain cost and I can make a certain reduction. But I hope we are not blind on one eye in the sense that we say, well, we managed with an energy consumption reduction this winter and we came out with a surplus, so we don't need it anymore next winter. And as Trevor said, and that's also our opinion, the next winter is as difficult as this winter, and we have to bet on the weather. So I hope it will continue to set the incentive in the case the market doesn't set the incentive.
Tobias, Germany has plans to sort of peg industrial power prices to the cost of offshore wind. Does industry need that kind of support going forward?
Well, again, it depends a little bit on the market. I think the industrial sector has two general development. One is, of course, the price level and the support on the price level itself. The second thing is what we need in the market is a matching of real green power with the energy consumption, and both matches in that sense. Yeah? So if you connect them and you have real green power. On the price level side, it depends on what cost levels we are talking about. In case, again, if the market is lower than that, then it doesn't really make sense. If the market is higher, it's always good to have this type of matching. But I've learned that you're always doing business in two. The offshore wind producers are not really happy about it to have a reduced price to a certain group of customers instead of selling it at a higher price level in the market.
You mentioned in the market design, or the threat of market design in your slide there, Tobias, but there's quite a major debate in Germany at the moment about the pros and cons of CFDs. Could you talk us through some of those? What's the level of debate at the moment, Tobias?
Well, the CFD is as a contract for difference for renewable energies, especially on the power side, fluctuating renewable energies, seems to be a fair thing somehow, because the current support was that in case the prices are lower and you're not a full merchant power plant, you're kept there, but you can profit from very high prices, which is a big incentive for investors. A CFD gives you a locked-in price. It's not a fixed fee somehow like the feed-in tariff, but it goes a little bit into that direction, that either you have to pay your surplus or you have to you get a certain financial support, which in case, let's say the price levels are okay, where at what level you're fixing the CFD, so what's your baseline, then it could be interesting for investors itself. The big question is, and what's the market price level? So what's the level at what you're fixing the CFD? Is it the forward price market of the power market? Is it a simulation? Or is it, as in Spain, a separate market somehow? Or is it an auction? And I think that's the interesting discussion. What's interesting somehow is that there's no question mark behind the CFD itself. So somehow it seems to be clear that CFDs are the way to go.
And do you agree?
Well, it's an interesting instrument to have this asymmetric approach, not in the market with the surplus, but it has the downside that if we want really to reach our huge targets of additional renewable energies in the whole system, especially in Germany, it's difficult to reach that with CFDs.
Trevor, one of the what we've seen as part of the energy price crisis and part of the incredibly high prices over the course of 2022, as well as the huge volatility, we've seen some companies making huge amounts of money. I mean, record profits across the board. These are mainly the oil and gas companies, while you have a cost of living crisis that Toby mentioned. The strikes are going on. The UK has certainly also been experiencing quite a lot of the coming over the past few months. I mean, so some people are struggling to pay energy and pay for food, whilst other companies are making huge amounts of profits. Do you see that there could be a potential backlash against the big energy firms, potentially calls for a massive grab in terms of windfall tax or something along those lines? I mean, we've seen fairly modest ones so far. Could the calls is there a danger that, or is there a threat that these could be, the calls for such moves could be increased?
Yeah, of course there is. I mean, it's, as you outlined in the question, it is it is very problematic to say, well, here's companies making billions, and here's a whole bunch of people who can't afford to, heat their house, and they have to choose between heating and eating. And I think these are, very, very big social questions. And, and certainly when you look at, calls to change market structure and stuff, it's kind of embedded in this, in this kind of dissatisfaction with the fact that, because you have margin, because markets work around the margin, and it's always on marginal cost. On cost, some people can make a lot of money, on investments well beyond, what they'd ever planned to make, And so there is this question of, well, is it fair that we take some of that away? Now, I think it will be an interesting, it'll be an interesting discussion, an interesting debate. I think there'll be a lot of political pressure, probably to do something around windfall taxation and getting that back possibly to consumers. It seems like, if you have a world where you have oil majors coming out and saying, well, we're not really going to do much apart from give this back to shareholders, then there's some very, very big political questions that probably get raised. And I think, if it's, we're not going to change how much we spend on transition, or we're not going to do X and Y, we're just going to give this back to shareholders, then it probably increases the willingness of politicians to begin to intervene, and take some of, take a bigger chunk of those profits away from the energy companies.
A final question here. We're running a bit out of time, so and this is a question that I've thought about a bit over the past sort of 6 months. So this is from Michael Bierman. He's wondering whether the high prices for gas storage inventory without hedging contracts will influence prices. So do you have any information about the price point, the Trading Hub Europe, at which point it might be financially beneficial to withdraw from storage?
Well, no, I don't have the information. First of all, I don't know at what prices they procured. There are rumors, or have been rumors in the market, that the market knew on what days they bought their gas in trenches, and market behavior was reacting to that. If you buy without any limit, so the assumption is that it might be the average price between April and October of the gas market, maybe 200 euro, but that's just a guess. But the bigger goal for THE was not to hedge prices or to make money out of that. The bigger goal is to avoid gas shortage and a huge economic crisis. So that's why I always say whatever it takes. Money doesn't really, or wasn't really important in that time, and it's not now, because if you take the mark-to-market evaluation of the gas inventory still left there, it's negative, and it's huge negative. But still, we are facing the next winter. The question is, does THE then sell it and make money out of that? And that's not the goal. The goal is to keep a strategic reserve until the market is behaving normal on the gas side. And this might take another year. And it's a loss. It's not as the whole procurement loss, but it's quite a huge loss. But it was well invested, honestly.
Anything to add to that, Trevor?
I mean, I agree with Tobias. This isn't a commercial play. This was a pure security of supply play. And they will keep that gas in storage until it's needed, and that could be next winter, or it could be the winter after. And certainly, I mean, the fact they didn't hedge it, what it did was probably drive some of, the backwardation you saw in the market, because you're driving up prompt prices all the time to buy all this gas, and so they were, doing it, like Tobias said, at some very, very high price. You just take the average summer price and see what that was, and it probably wouldn't have been far off. But what it does then is just lead to the backwardation, because nobody, it's kind of keeping the forwards a bit higher because nobody's selling into the market. But once you get into that period, because you've got all of that gas that's already been bought and paid for, just kind of sitting there as a big, buffer for any demand shocks, then it takes a bit of that risk out of the market and allows prices to come down a bit, which is what we've seen, this winter.
Trevor and Tobias, thank you very much for an excellent, very insightful discussion. If I were to summarize, I would say, the energy crisis, the worst of the energy crisis, perhaps over, but we're certainly not out of the woods yet. So, gentlemen, thank you very much for today.
Thank you.
Always a pleasure. Thank you, Richard.
Thank you. And listeners, apologies if I wasn't able to pose your questions, but we'll be returning at some point in the coming months for more webinars. So please join us then. Thank you and goodbye.